stocks have been taking a beating in the past week. Last night, when the closing bell rang on Wall Street, all three of the major indexes were down. The NASDAQ, which is dominated by tech stocks, have been losing ground, was hit the worst, falling more than 3%. Our investment advisor, Bruce Allen, with Bruce G. Allen Investments, is here to look at what happened so far this year and the free fall the market is in. We always invite him when things are really bad. Nice to see you.
It's nice to be.
All right, so what's going on here? How bad is this?
Well, I think if we look at the averages, you can see that there's a different tail whether you're looking at the Dow, the S&P, or the NASDAQ. So the Dow Jones is so far is down a little over 12% this year. The older stocks with dividends are down less than the S&P 500, which has a broader mixture, and that's down 17%. The NASDAQ has passed that 20% decline threshold. The NASDAQ is now down 27% as of last night. And so what that means is that, typically up to 20%, they call it a correction. Beyond a 20% decline, it's called a bear market. So the NASDAQ and the tech stocks are now in a bear market. And those are interesting nomenclatures, but still, it doesn't matter too much. If you're down 27%, it still hurts all the same.
Yeah, absolutely. We always ask you this. It's a hard question to answer, but what's causing all this?
I think there's three big reasons why the market's declining. Number one is interest rates have risen dramatically. In August of last year, the 10-year Treasury bond was at 1.17%. It's now it hit 3.2% earlier this last week or so, and now we're back in just under 3%. As rates have risen, that's causing bonds to be more competition for stocks. So professional investors are moving some money towards the bond market as the interest rates have risen. Number two, with rates going up, that means mortgage prices are going up. So it costs more to buy a house today than it did 8-9 months ago, significantly more. And there's a concern that that pressure will slow the economy down. And lastly is, many people are predicting recessions. Some of the same folks that did not predict a recession in 2020, which did happen, are now predicting that we will have a recession come later on this year. So there's a lot of concern about the economy slowing down.
You can't leave without giving us some good news, right?
There's a lot of good news too.
Okay.
Three things. One, the first one is $18.2 trillion. Before COVID, there was $13.2 trillion in the banking system, in our checking and savings accounts. Today, that number is $18.2 trillion.
Wow.
I've never seen this in my 37 years where Americans saved that much money. And I'm not sure I'm ever going to see it again, but we'll see. But that money's getting spent. And what we're seeing is significant consumer spending. So while many economists on Wall Street are predicting a recession, the most reliable predictor of recessions is the bond market. And the bond market is not predicting a recession. So that's a good positive. Number three is the leading economic indicators are also positive. So the signs of a recession happening, while many on Wall Street may be worried as the stock market's declining, that's not showing up in the accurate predictors of recessions. It's not showing up. And I think the last part of this is that we're Americans. We've saved a lot of money in COVID. A lot of people want to go on vacation. They want to enjoy the world. They want to get back out. And with all of the consumers having spent some significant amount of money, that money is now starting to get spent. And Powell referenced this last week when he talked about this. Consumers are in very good financial shape, and the job market's terrific. So we have lots of good news overshadowing some bad news. But having said that, the stock market's kind of adjusting to its own new world here.
Okay, we'll have to see what happens. I won't ask you about coming on last week and talking about how great things are and then the $900 drop. Anyway, a 900% drop.
Good to see you.
See you. Okay.